Good morning from Chicago traders. It's 8:01 a.m. Central Time on Tuesday, the 26th of July, 2016. This is another Trader Bite, early nourishment for your trading mind. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The key driving news overnight is really the Japanese yen. The yen is currently up 1.47% on the futures, mainly due to an imminent shift from fiscal tightening to loosening, has reduced the pressure on the Bank of Japan to provide more stimulus. So the expectation from the market is that the stimulus will be reduced, therefore increasing the currency's value. Uh, Japan's finance minister Asu came out last night at 11:30 or so Chicago time. Government yet to decide on size of stimulus spending, still considering appropriate amount. So that's really driving that market. Credit conditions in China are the strongest that they have been since the peak of China's boom. The reading was at 9.2%. This was since 2010. And Morgan Stanley has released a report predicting that oil will continue heading lower, citing worrisome trends for supply, demand, and refined products. Other than that, really, so far we had earnings releases. We're in the middle of earnings season here. McDonald's came in at $1.45 versus $1.38, beating its estimates. However, its revenue numbers came in light, 6.27 billion versus 6.29. 3M also reported 2.08 in line with revenue also short 7.66 billion versus 7.72. And of course, we got DuPont coming in at $1.24 versus $1.10, beating. Revenue also beating by zero point zero 0.01 billion, 7.06 versus 7.05 billion. And British Petroleum came out as well. There's, we got to pay attention to the earnings currently, although it seems like the market's just being lazy right now. Risk capital, risk capital this morning is mixed, moving into mixed areas. Crude oil taking a hit, again down 1.32%, trading at $42.57 in the September futures contract. The US dollar is right behind it, given the strength of the yen. And then we have the Dow and the S&P being negative. And then the positives are the British pound, which is slightly over break even, the Russell, the euro, and then funds are moving into the 10-year treasury, as well as gold and the US bonds. So there's a the sentiment this morning is mixed. We'll go over the technicals here in a minute. Um, just to show you how messy an area we're in right now. So let's take a quick look at that. Again, that's the usual overview of where we were. I focus mainly, for those who are new here, I focus mainly on the S&P 500 simply because I'm speaking of futures, but it's all correlated. If I cover the S&P 500, I'm covering pretty much a vast universe of equities as well as futures indices. So being as it is the most popular futures product out there, this is why the ES is the focus. On the right here, you'll see a chart called the cash indices. It looks like a seismograph. And what this is it's a 1 second chart of various products, and it resets every morning. And it starts at 0% on the open. And what I'm doing is I'm correlating all these instruments. So from bottom to top here, XLV is representing healthcare, financials, industrials, consumer discretionary, and techs. account for about 76% of the S&P 500, and those are represented here in dashed lines on this chart, just to give you an idea, an overview of what you're looking at. So yesterday when we closed, um, you know, by the time we closed, which is way over here, transports were really dragging. Transports were very weak yesterday. They could not breach the mid once the session started. Followed by QCL, which is crude oil XLI, the industrial ETF. EX is the Eurostox, XG is the DAX, YM is the Dow, DX is the US dollar, and so on and so forth. This green line here is the S&P. And what I'm looking at is a correlation starting at 0% right on the opening print. And it looks at the close of every 1 second bar versus the where the market opened, and it gives me a percentage up and down. And what this does is it helps me read on a percentage basis what is leading and how the underlying sectors are behaving. The bottom right here is the S&P 500 breadth. This is the advancers minus decliners on the S&P 500 only, not the New York Stock Exchange, but the S&P 500 only. So this chart technically cannot get over 500 or below negative 500. So we can see how, with the zero line here, we can see how the underlying stocks are responding on an advanced versus decline basis. So that's what that is. And in addition to that, what we usually refer to is the daily, what I call a composite chart. And what this is it's a chart of daily bars, and these daily bars only show the RTH session or the daytime session or the pit session. It shows the action. Each bar represents 1 day of action on the pit session, and it brings in the profile. On the right's a composite. This is a volume-based profile. This is volume at price going back to October 9th. So you can see here the start date, October 9th, 2013. This is a quick overview of what you're looking at in case you get lost as we're going through and concluding with our hypos. So you can see from the low of Brexit to where we are, where we currently have our high, is approximately 180 points in the ES. A pretty substantial move up, and the market has been consolidating for the last few days. When the market consolidates for a few days, what we do is we put a composite, a profile of those consolidation days. So if I send this to the back, you'll see that we gapped up on the 14th last Thursday or 2 Thursdays ago, and we have been trading in this tight range ever since. Pretty tough trade currently, but the consolidation type trade, balance leads to imbalance, and so we're conservative during this new all-time high type of phase. It's a tough trade for pretty much anyone that day trades the market that I know. And in any market, people can make money, people can lose money. It just depends on your style and what you're doing. And then, given that yesterday was a part of this balance, we moved this composite forward, as you see here. And as the composite moves forward, you can read into where the volume went for the day. So you can see that volume shifting as we go forward. And now we've included yesterday in our composite, and the most valuable price on this composite has dropped to 21.59 and a quarter, and that becomes our what's called micro composite point of control. That's a key figure that we need to keep track of. The lowest point on this composite, as you see here, right there, it's called the microcomposite low volume node, and that usually generally is an indication of a price that the market did not accept, and it generally acts as support or resistance on an initial test. And you could see that yesterday we started to move back towards it. We broke through it yesterday. I talked about it a lot, and we broke through it. We pulled back to it, tested, and continued lower. Which brings me back to always reviewing what I had said the day before, so you can see how things played out versus what was expected. This was yesterday's Trader Bite, done live at the same time here at 8 a.m. Chicago time. This was my primary hypothesis. The primary idea is that the market will chop around, start to move down towards that 164 and a quarter area, this orange line that I drew, and then look for a advertised price low enough to shut off sellers, motivate buyers, and then we're likely to continue to move out of this area because of this high volume node to the right, and the fact that we are um, in a trend up. So that's what I was looking for as a primary hypothesis. Clearly did not work out. The secondary hypothesis was on point yesterday. Looked for choppy, an attempt higher. It did make an attempt higher, could not close. By the time the trader bite ended, it actually opened down here. It tried to move to the Friday's close. It missed it by a tick, and then from there, it just pulled back and it started to move down. We ended up testing all the way down here, and then the market rallied back up into the close. Hypo 2 was in play yesterday. Tough to jump onto it. Tough to jump onto Hypo 2 yesterday. It's once it pushed through, it gave us a couple of opportunities that I'll go over here in a second. So here's a view of what happened yesterday. These bands that you're seeing, I added those yesterday. These bands, these are half-hour bands. Essentially what this shows is how much time it took to build these two-tick Renko bars. And the wider these bars are, the wider the 30-minute session is, the more bars it took, or the more bars printed, or the more the market moved in that half-hour phase. And so you could see that when I scroll back, it's usually the first half hour is usually the widest band. That's to be expected. That's the most volatile time, and that's why we keep track of the opening swing and so on. So that's that. Let's put this to the side. Um, and so yesterday, what do? We open, we test one tick below the Friday close, as I said, we drop, and the first opportunity to sell comes right here at 2164.75 against the mid. Hard to see. There we go. Let's pull that up like that. Uh, Against the mid, and right there. And the opening swing low, that's the opening swing low right there. That was the first opportunity to actually capture a short. The second opportunity occurred right here, for a small rotation. That was only good for about 3 points, 4 points. I did not see many clear plays, as I discussed in yesterday's Trader Bite at the end, that this is a time of the year where you want to be fairly conservative. The tighter that the market winds up, the more balanced that the market is, the more likely it is to break, creating an opportunity for us to participate in a more volatile environment. And so overall, what we got yesterday is we got a test of the prior day's low right down here. The market tried to hold prices below there, and then it started to shift up. We finished on basically a B-shaped profile. So if I had this profile on the right, it would look something like this, like a letter B, long liquidation type of profile. But the market ended up finishing above the point of control, back in the middle of the range. So overall, we did not accomplish much in terms of what we did yesterday. So when we look at the composite here, the micro composite, all we did is we tested below the micro composite, this black line, and we finished above it. We are still challenging this 2164 and a quarter area. This is a key area that I'm going to continue to watch today. We are in a balance zone since the 14th. And so what you want to do is per the hypos that we're going to go over here, we're opening in the middle of the range. in the middle of yesterday's range, right above the mid, above the point of control. So the expectation, the primary expectation coming into today is going to be responsive selling. The overnight session didn't do much. Let's take a quick peek at the overnight session to continue to build our case. The overnight session, high, a very tight profile. The volume on the overnight session, however, is 201,000, just 1,000 above the most common um, volume for the session, which is 200,000. So volume is in line for the session. It's not light. It's not. It wasn't. It wasn't. Drying up or anything. But overall, the overnight inventory is neutral, which means that there is not. That there doesn't appear to be an imbalance between yesterday's close and today's trading. The point of control overnight is right on top of yesterday's close. It's higher than the prior point of control. The market tested the prior point of control below in the overnight session and is holding in the middle. What this is saying is expect a pretty lazy, probably um, uh, to probably expect a lazy open this morning. So the expectation this morning is an open auction out of range. I'm looking for responsive selling back to 2159. I'm looking for this to be a magnet to attract price. And again, I have to keep playing on the long side here. We already tested the downside, so I'm looking for the long side to start playing out, and that'll be my hypo one. Hypo one target is the all-time high, and again, 2174 and a quarter beckons up here. This is a measured move target up here, 2174 and a quarter. That's what I'm looking for. So open auction in range. So I'm looking for a choppy open, looking for a release downwards. This may or may not happen. If it does, then I'm looking for a base at 2159. If I'm able to capture any shorts, then I'm looking for 2159 as the target. So I'll probably front run that price. And then I'm looking for it to base at the point of control, which is yesterday's point of control plus the micro composite point of control. Looking for it to base there, looking for that to be a magnet that is the most traded price in this area. And then I'm looking for buyers to step back in as they did yesterday. So I'm looking for a continuation of that. And then, of course, test the gap close above from Friday and then continue to move up. Hopefully, if we can get a runner to run. We haven't been able to get a runner to run lately. The secondary hypothesis, chop. Again, the secondary hypothesis assumes the opposite. Chop up to 2164 and a quarter, looking for it to test up there, drop, and then get down to 2159. If it's not able to push back through, then I'm looking for this to start moving towards the the composite LVN zone down here, with the extended target being 2146. But the low of the range here is 2149, and that's as it enters this low volume node between 2152. If it gets below 2152, I'm not going to be looking long. That is a low volume node that's likely to go down to 2149. Once it does that, that would be hypo 2. Okay, so our job this morning, so how do we use these hypos? Um, how do we use these hypos and how do we apply them? Our job is not to impose our ideas on the market. Many people do. Many people see this as a challenge to validate your idea. Do not look for the market to validate you as a person, validate your capabilities or your intelligence. It is the wrong medium for that. It is a very, very expensive place to try to prove something to someone. Don't use the market for that. What the better approach, and the approach that requires a little bit of wisdom, and maybe you need to get your teeth knocked out a few times to really for these words to mean something to you. The better approach here is to find out who is in control. Where's the money moving to? who is in control, and then to align yourself with that greater force. And the way we measure who is in control is to find out what levels are being tested and breached, how good of a job it's doing, what it's trying to do. And then our hypos are simply giving us a plan. So if the market moves up and it finds sellers and it's having a hard time continuing higher and starts to roll over, we know our hypos just simply tell us, look, 2159 is likely the next area to test. 2164 and a quarter being the composite low volume node is probably a good area for the market to pause and rotate. And so we look for areas there. But once it rolls over and we're in a trade, this gives us an idea of what to expect the market to continue to do. The idea here is not that I want the market to do exactly what the hypo says. That is not the objective. Oftentimes it does, but that doesn't mean that I'm some sort of a genius or have a crystal ball or you should pay me a bunch of money to teach you how to predict the future. There's nothing to that. There's nothing like that to the way anybody trades. And if anybody tells you otherwise, they're selling you. They're selling you on a magic potion that doesn't really exist. Your goal is to continuously test and retest your alignment with the market and to take positions in that direction. That's it. And my goal is not to catch the high to the low. That's not my goal. My goal is to execute solid trades and to capture a portion of the move with the bulk of the size that I have on, and to keep something on in case the market continues to run, and then to add back on if the market turns into a trend, which you can do at any time. There's no way for me to predict a trend either. If I could, I'd be running a multi-billion-dollar fund rather than trading my own account. Okay, so that's the honest truth. Hopefully you learned something there. It's a long trader bite, but it's a good refresher after the long break here. Hopefully you gained something from it, and good luck. Watch your risk. Risk is king. The difference between you and someone who used to be a trader is your ability to manage risk. Remember that. Good luck.